This is Colin Cattell with Palisade Radio. On the line with us today is a good friend and technical expert, Jordan Roy-Byrne from the Daily Gold. Jordan, thanks for being with us.
Hey Colin, thanks for having me.
Jordan, let's touch on the COT report, or Commitment of Traders. The commercial traders who are the users and producers have added more short positions for the metals of late, and many analysts say that we should be concerned about this in terms of gold and silver. What do you make of it?
Well, that's a good question, Colin, and I don't consider myself a top expert on the COT report because I know there's other people who really delve into the specifics in the different categories, but I just look at commercials, and then, in my opinion, everyone else is a speculator, and that's pretty much how most people categorize it. And the commercials, as you said, they need to, because especially if you're a mining company, you need to protect yourself with hedging and shorting the market. I mean, if you're a producer of gold or silver, and the gold and silver price is going up, you don't. It's your business. You don't gamble that it's going to keep going up. I mean, you sometimes have short contracts, and sometimes you hedge into the future. So typically, that's why we always see the commercials are net short in a bull market. And in a bear market, obviously their positions are more neutral, or even sometimes they get slightly long. And the one issue that I have with some readings of the COT is there's this idea that, well, the commercials are always right, the speculators are always wrong, and that's really not the case. I mean, what you need to look at is the speculative positions and really the level of those positions. Because recently, what we had a couple weeks ago, I mean, we had real extremes in these reports. So in other words, the net position for the speculators was really, really low. I mean, it was almost nothing in silver, a little bit higher than that in gold. And so what we've seen, the market has recovered, and the speculators have added a lot more long positions, or their net position has grown more long in the last couple weeks. And so some people are looking at that and they're saying, oh, no, I mean, the speculators are usually wrong, and they're adding a bunch of long positions. But what we have to understand are two things. First of all, when you're dealing with sentiment, it's all about extremes. You really need to be on the extreme bearish or bullish side as far as whatever you're looking at for it to have a big impact on the market. Secondly, the way I look at it with the speculative positions, I mean, is there room for them to continue to increase or decrease their positions, and what level is it coming from? So as I said 3-4 weeks ago, these positions were very, very low. For example, when I put gold and silver together and I divide the net speculative position against open interest, right now it's at 39%. Now, if you go back the last 15 years or so, the highs, the absolute highs, tend to be around 60%. Whereas from 2002 to 2012, the lows were at 25%. Now, I don't have the chart in front of me, so I don't know what the recent bottom was, but it was probably below 10%. But if you look at this from a very long-term context, we're at 39%, and if you get to 50 or 60%, that's the time when maybe you could start to worry a little bit and say, well, the speculators have really been adding a huge amount of positions. The net position is already at 55 or 60%. How many more positions can they add? I mean, you need to look at that and then weigh it against the trend in the market. I mean, that's when things potentially, with where we are right now, that's when things can get bearish. So we've had this rebound. I mean, the stocks have been very strong. The metals, not quite as strong, but the metals have firmed in recent weeks. And so the COT report, to the amateur eye, it looks bearish. But what it really tells us is that the speculators are now, remember, in the bear market, the speculators were shorting and selling. They weren't buying. They've now seen the trend change, and now they're buying, and we don't really need to worry about they're reaching an extreme position. Not yet. I mean, perhaps in the next couple months, that's a possibility. But as far as now, I don't see that having a negative impact on the market. I mean, the price action is far more important. The COT is a sentiment indicator, and like I said, Colin, you really need, with sentiment indicators, it really needs to reach an extreme position to then have an impact on the market, swinging the trend reversal in either direction.
Jordan, you just mentioned the metals have firmed up a bit over the past few weeks. However, some other commodities have been making different movements. Grains had a big sell-off, and oil seems to be breaking a bit to the downside. Do you see a negative impact on metals with other commodities dropping off?
Well, that's a great question, and I think the bears and those who've missed this bottom, in my opinion, in the precious metals, they're looking at the little breakdown we're seeing in the commodity sector as possibly a catalyst for precious metals to turn around and resume a bear market. I really don't see that. If you look at the grains, they made, I believe they peaked in. I'd have to. I have a chart, but I don't have a long enough time frame. But looking at grains, they made a high in 2011. They corrected it. Then they made a higher high in 2012. So they haven't been in this 3-year nasty bear market. So they're with the grains, you could potentially say that the bear market possibly started in the middle of 2012. And so they're just not, at this point, they're not as oversold as the precious metals. They didn't have as severe of a bear market. So there's a little bit more downside there, perhaps. And looking at energy, I mean, the energy complex has been very strong for a while. We're seeing Brent crude break a little bit, as you said. One thing with crude oil in recent months, in recent quarters, I believe, the speculative long positions in oil have been at a major extreme. So it's interesting because this is what we just discussed. These spec long positions in oil have been, I don't have that chart in front of me, but those positions, if you look at the COT, they've been at a speculative extreme on the bullish side for quite a while. Yet oil has continued to climb slowly and steadily. But if it looks like oil's breaking here, and if it continues to break, then what you have is you have a lot of speculators who want to cut their losses or lock in their profits before the market goes further. So because of the COT report there, you could see more downside in energy. But energy with respect to precious metals, I mean, energy really hasn't been in a bear market. I mean, looking at the GJX, which is the Goldman Sachs, this is the S&P Energy Commodities Index. This thing has basically been in a sideways market since 2011, and a couple weeks ago it looks like it may have hit a 2-year high or was pretty close to it, and it's coming down. But given all the events that are happening in the world, I have a difficult time seeing a real significant decline in energy commodities. So the commodity complex, I mean, looking at the CCI, that chart has had a reversal and does not look bullish to me. But it did make a pretty good bottom middle of last year and then at the end of last year. And so perhaps we're coming down and we're going to test that bottom. I mean, it's something we need to keep an eye on, but it's having no impact on the precious metals or the precious metals stocks right now. The price action in the entire precious metals complex remains really strong. I don't see anything negative there. The weakness in commodities, it does have some potential, so it's something we need to keep an eye on, but I really don't see that happening. And the last comment I'll make is, remember, oil or energy in general is a huge cost input for the miners. So if we see energy prices start to come down, that's very positive for the margins of gold and silver producers. So that's actually something. I mean, it's difficult to say because it depends on so many other factors. But the fact that we have precious metals stocks so strong and coming out of a nasty 3-year bear market, if we get on top of that, we see a decline in energy costs. I mean, that's another positive development for the precious metals miners.
And let's talk about the stock market, which is looking very strong to me. A lot of gold investors are concerned to have a repeat of 2008, whereby the stock market crashed and the gold and silver stocks crashed at the same time. What happens if the stock market does correct? Will that have a negative impact on gold and gold stocks?
Well, it depends what kind of correction. At most, I would maybe having a slight negative impact. The key here is This is something I've studied going back since the Great Depression. I've looked at how precious metals perform and against the stock market, and I've compared the two. And the correlation it's all over the place, and it's always changing. So it's never static. And what we've had since the summer of 2011, we basically had precious metals have gone down. They've been in a bear market, and the equity market has been in a great bull market, has continued higher. And what we've seen recently is the precious metals are recovering. The stock market has continued to inch its way higher, although some of the really hot sectors from 2013, such as technology and biotech, is looking a little suspect. So we're starting to see some weakness there. I mean, I think this bull market is really long in the tooth. I do think we're going to see a cyclical bear market in the S&P pretty soon. But that's not a negative for precious metals because the two haven't trended together. You go back the last 3 years, as I said, there's been a negative correlation. And so what happens is the correlation between the two, it usually, when it's negatively correlated, it's going to stay the same for a while. If you go back to the 70s, from 1972 to 1978, the two sectors were negatively correlated. So at first, you had precious metals perform fantastically, and the stock market went into a bad bear market. And after 1974 and 1975, very similar to what we've seen in the last couple of years, the stock market and economy started recovering a little bit, and therefore precious metals, which had appreciated tremendously in the last couple of years, they started turning down. So the negative correlation continued. And then, of course, we all know there was that bottom in the late summer of 1976. Precious metals began a new cyclical bull market. They resumed their secular bull market. The stock market then had a 20% mild correction. And then eventually the negative correlation broke when the stock market started following precious metals when they went to a bubble. And that kind of began at some point late 1978, I think. And the same thing happened from 2000 to 2002, 2003, where the stock market was in a bear market, but precious metals and precious metals equities were in a great bull market. And so that negative correlation actually kind of began, I think, in 96 or 97, where the stock market kept going up and precious metals, of course, had a nasty bear market. So, I mean, how is this relevant to today? Well, there's been a negative correlation since the summer of 2011, and so history tells you that's probably going to continue, or it tells you that if the S&P falls into a bear market, that's not going to impact the gold stocks. I mean, the only way I see it having an impact is, let's say the gold stocks continue to go up from here till the end of the year and the S&P continues to go up. Well, in that instance, then if the S&P begins a bear market next year, I think the gold stocks could be a little vulnerable. But from where they are right now, they're still, very early in this new bull market, and I just don't see the potential negatives with respect to a bear market in stocks having a negative impact on precious metals. Colin, it's actually, I mean, if it happens soon before the end of this year, it's actually going to be a catalyst, because there's all these people who made a lot of money in stocks, and if they start selling, where are they going to put that money? I mean, and if they see precious metals going up, then that's going to entice them to move money away from equities into precious metals.
Jordan, great insights as always, and great news for precious metals investors. Looking forward to having you back here soon.
Thanks for having me, Colin.